If you're running a business, there's one number that can make or break your profitability, and that's your direct costs. It's also called cost of goods sold, or COGS. Direct costs are expenses directly tied to producing your product or delivering your service. They determine your gross margin, the money you keep from each sale before all the other expenses or overhead. Master this and you'll transform how you price and grow your business. Now, don't worry about taking notes. Everything's captured in our blog article on direct costs, and it's linked below. The first thing you need to do is identify what counts as a direct cost for your business. Direct costs include raw materials, production labor like assembly workers, and for resellers, what you paid for the products you sell. And if you're selling a service, the commission your salesperson makes would be a direct cost. Now, this does not include your overhead, rent, utilities, marketing, or employees that aren't directly making the product. So that's the definition. Direct costs are what go directly into making or acquiring what you sell. The key is translating that understanding into your actual financial structure. I'm going to demonstrate this in LivePlan, and you'll see how the platform guides you to input these costs in the right places so your margins calculate accurately, and then you make better decisions. So let's dive in. So you can see we're back in our coffee shop, right? Everybody understands a coffee shop, easy place to be. I'm in the direct costs in LivePlan, and you can see that I've actually already put in different things that have direct costs. I've got espresso drinks, I've got tea, I've got baked items, I've got lunch items, I've got cold drinks. So let's click in here and see what we've done. One of the cool things that I love about LivePlan, and again, you can do this in a spreadsheet or somewhere else, but LivePlan really holds your hand to do this so that you don't have to overthink it, is that I can enter these espresso drink costs as a percent of a revenue stream, right? And so I want to put it in as a percent of the revenue stream called espresso drinks. So I can do that, and then you can see specific cost, espresso drinks, and what percentage of this revenue stream. Well, that's where I have to do a little calculation, right? So what goes into that espresso drink? Well, there's a cup, there's probably a lid, there's probably some milk. A lot of espresso drinks have milk, right? Maybe different kinds of milk, and then there's the espresso. So I have to make an estimate of what it costs me every time I make a drink. For me, 30% of what I'm actually charging for the drink is what it costs me to make. And that is actually a really good margin, right? For every dollar that I make selling my espresso drink, I'm only spending 30 cents on the cost of goods, which is great. That means I have 70 cents left for overhead costs and hopefully for some profit. You can do the same thing on any of these cost of goods. Now, the last one I want to show you is that we can add direct labor, and in LivePlan, again, really easy. You can see we have this category, and I'm going to add a salesperson. Not that I would have it necessarily for a coffee shop, but maybe I'm doing corporate sales and maybe I'm getting that out there. And the salesperson is going to really allocate their commission as the actual direct labor, right? It's not everything they do. So I'm going to put in a percent of a specific revenue stream, and I'm going to say that this is a salesperson who's selling the coffee consultant, and I'm going to say that we don't want to spend more than 20% in that person's time, because otherwise my margins aren't going to be good. Now, I may have to come back to this, right? I may have to, once I start selling things and I see my actuals, make adjustments. But this is a guess, it's a good estimate, and I can tie that direct labor directly to the revenue. So that's what I'm going to do. So you can see, as you think about those direct costs, having a really good idea of what they are, and then you can come in here and look in LivePlan, and you can see that we now have direct costs, and we have all of our revenue, and we can see a gross margin for our business of 60%. I can now take that gross margin and I can compare that to industry standard, and I get a really good idea of where I am. If everybody else in the coffee business is making a gross margin of 70%, that means one of two things. Either I'm spending too much on the cost of goods, or I'm not pricing high enough. But now I know two things, right? I either have to price higher or I have to find better suppliers, and I have information that I can act on, which is what you want when you think about direct costs and gross margin. All of this, from calculating your gross margin to seeing how changes in direct costs impact your bottom line, is exactly what LivePlan is designed to simplify. If you want a clear view of your profitability, use the link in the description to get 50% off of your first month. So here's where this gets strategic. When direct costs creep up, they squeeze your margins before you realize. We're gonna take a look at a 12-month margin trend analysis, right? So we're going to look at this and we're going to see right now we're in the profit and loss table, and you can see that the first year my gross margin is at 60%, then it goes up to 62%, and whoa, what's happening in January of 2026? All of a sudden my gross margin is at 94%, right? So I have something I should look at. I need to jump into here and figure out what's going on and why is that happening. Now, the key here is not this action that I'm doing, right? I'm going into direct costs and I'm looking to see what's going on with my direct costs. And you can see here that I'm looking at it in an annual breakdown. I can see that part of the issue is this direct labor I added, and I only added it in certain places. Now, I know, and you guys know, I was adding that to just show you how it all works. So I can go back and say, actually, I don't need that salesperson. I'm not going to do that. I don't like what that does to my margins. And I can delete that item. And now my direct cost is really just going to be much more about that average margin for a coffee shop. This is what's cool, right? Is that if you're looking at this, you can do some what if scenarios. What if I add someone to sell that coffee consultant? Well, if I do, my margins really look terrible. Never mind, I'm not going to do that. This is what planning is all about. It allows you to test different things and make decisions before you spend the money, and you make some really bad decisions that could be bad for your business. So here's what I want you to do right now. Review your current direct costs and make sure you haven't missed anything or misclassified expenses. Calculate your gross margin percentage and compare it to industry standards. Most importantly though, start tracking these changes over time. When costs begin creeping up, you'll catch it early and you'll take action. Remember, direct costs are the foundation of profitable pricing and smart business decisions. Master them and you master your margins.